Hi, good afternoon, Deepak ji. We can't hear you, Deepak. We can't hear you. No. No.
Huh? Hello?
Yes, Deepak. Yeah.
Yeah, now
No,
you're
it's
audible. Yes, yes.
Hi, Bella. This is Gokul logging in.
Hi, Gokul. Just getting calling all the other colleagues.
No worries. I thought I'll just do a sound check while speaking to you.
Yeah, I think that's good. It's all good. I just can't getting hold of Ishwar.
Yeah. Hi, Gokul. Welcome.
Good afternoon, sir. कैसे हैं?
Fine, Gokul. All fine. Thank you. So maybe we'll wait for another 5 minutes. Now it is 3:56. So there are about 31 participants. We'll start at around 4:42.
Hi, Bella. You were checking whether I joined?
Yeah, you're here. Okay.
I'm already there.
Good, good. Thanks, Ishwar. Then
I just will take off my this thing. I was just in a car, but I'll take that off in a bit.
no problem, no problem. I think as long
Hi,
as
Ishwar.
Good evening.
Good
Dr. Bakri,
evening.
good evening.
Good evening. Good evening.
Jimit and Anup should also be joining, but yeah, we can start.
Am I audible?
Yes, Anup. Yes.
Yeah. Yeah, you are.
Thank you.
Yeah. Hi, Karthik. Hi, Jesse. Yeah, hi. How are you?
When you want to do a sound check, we're going to start in a minute.
Hello. Yep. Good.
Yeah, that's good. Yeah.
Hi, Jimit.
Hi. How are you, sir?
I'm fine, Jimit. How are you?
Good. Nice meeting you again, sir. Long time.
Same here, Jimit. Vivek, you have joined?
Yes, he's joined. Yeah.
Yes. So we can start now.
Yeah, we should start.
Yeah, good afternoon.
We have about 55 participants, so we can start. Yeah. Yeah. So good evening, everyone. My name is Jaswinder Bakshi. I am the treasurer and convener of the finance panel of ICEMA and part of Tata Capital. On behalf of ICEMA, I welcome our guests from Deloitte, esteemed panelists, GC members, ICEMA secretariat, and all the members who have joined us for this session. Needless to say, the last 2 years have been challenging in terms of health and economy. Like many other industries, the industry also went through ups and downs. Second half of financial year 2021 turned out to be one of the very good periods for the industry. And in FY21, we almost touched the figures we achieved in FY 18-19, an year which is considered to be a golden year for our industry. For last 4 months, some of the equipment categories, particularly in the earth-moving equipment, started facing a slowdown. This was triggered by a lot of factors, including an extended and heavy monsoons, increase in the input costs of like diesel, steel, etc., BS4 implementation and resultant equipment price increase, reduction in the pace of construction in some areas, and we are seeing some kind of conservatism by some of the NBFCs in lending to the smaller customers. On the other hand, equipment like mining, crushing, concreting still held the ground due to a very good demand in iron ore and coal mining sector, high-speed railways and urban infra. We also see a very good movement in cranes because of, again, high-speed railways and metro work. Sea industry is one of the few industries which has laid its own vision for the year FY 2030 in terms of growth, technology, emissions, employment, and skill development. We aspire to be a $25 billion industry by turnover from the present $6.5 billion and would be contributing to the employment of about 6 million people, from the present about 3 million people. The industry was waiting eagerly for this year's budget due to the condition what I told you. Like last year, we have joined hands with Deloitte to give us their expert views on what the budget means for us. We will also have a panel discussion to discuss some of the specific issues. With this, I would like to invite Mr. V. Vivekanand, Vice President ICEMA and Director Caterpillar India Private Limited, to address all of us on behalf of ICEMA. Yeah, over to you, Vivek, please.
Yeah, thanks, Jesse, for that starting note. And again, a very warm welcome to each and every one of you for this post-budget session. And as Jesse said, definitely we have been going through a significant amount of disruptions in the last 2 years, which is definitely unprecedented in the advent of COVID. And as Jesse pointed out, we have always also been seeing some surprises because we never thought we would actually recover so fast after the advent of COVID in the year 2020-21. And the market came back pretty fast. And I would definitely say that the government of India has got a significant role in the form of a stimulus, as well as the sentiments which eventually triggered the demand for the product, especially in the construction space. And of course, after the second wave of COVID, which was also caught us unaware of, and I think the demand again took a slight dip. It's not as deep as what we envisaged in the first wave of COVID, but again, it started coming back. But again, it didn't really come back to the normal to the extent what we envisaged. And obviously that is one of the reasons why we always strongly felt that this budget is going to be extremely relevant to us. And going by the finer aspects of the budget, I think the budget is definitely laying down something what we really wanted, because the government didn't really go behind the consumption, rather the government went behind the investment route to actually just revive the economy to where they aspire it to be. And I think obviously investment means a lot to us, because the focus of the investment, what the government has laid out is actually on infrastructure, which is closely tied to our industry. As we shape India's tomorrow, investment on infra is definitely a foundation to shape India's tomorrow, which will eventually help to revive the demand of the industry as such. And I know there are definitely a lot of many dimensions and perceptions and opinions about what this budget could bring to the table. And we have a lot of industry stalwarts and eminent speakers to share the perspective. And I would definitely want Deloitte to share some of the insights of the budget to start with, and then leave it to the panelists who are actually the industry captains, who can actually share the perspectives on what they feel about the budget. And then we can definitely take some good questions and also perspectives from all the participants, so that we can all go with a good amount of optimism to face the future. And as Jesse said, definitely ICEMA has got a bold goal of tripling the industry. And I do strongly believe that we were actually down the trajectory of that, and except for the last few months, maybe a quarter, which actually just put a little bit of a dull moment to it. And I'm sure with this budget, we can revive that trajectory and then get to the right point. So with this, I would actually just turn it over to Deloitte to walk us through the budget content, and then we will listen to the panelists. Thank you.
Thanks. Thanks a lot, Vivek. Thank you for the wonderful address and very thoughtful one as always, and also laying down the expectation from this session. Thanks a lot. So from there, now we move to the next section of this session. So now I invite Mr. Iswaran Subramaniam, Partner Consulting Practice Deloitte, Mr. Jimit Devani, Subject Matter Expert Direct Taxes Deloitte, and Mr. Anup Kalabat, Partner Indirect Tax Deloitte, for a presentation on the economic overview and Union Budget 2022. Yeah, over to you, Ishwar. Yeah.
Thank you, Dr. Bakshi. Am I audible? Is it okay?
Yes, very much.
So thank you so much, and thanks to you and I'm Swan Meganathan. Thank you to you too for the context. And I think you sort of set the ball rolling, like what you said. I think one of the fundamental traits of the budget is that it's very fiscal in its nature, and therefore it's a supply side led model that is being discussed. And we'll sort of come to some of those dimensions. The second one is, there has been a significant continuation from the last year. So the last year, we had a lot of discussions around the National Infrastructure Plan and therefore the associated investment plan. Together, later, we also had the National Monetization Plan coming up, and later we had the Gati Shakti. So to a large extent, I think we also have a significant continuation with regard to infrastructure and public investment-led model. So just to give you a perspective, and I will start with the economic overview, which will give you the context to this whole thing, so that you know where the economy is heading, and therefore how does the budget fit into that context, so that we are not discussing things which are contrary to each other. So if you really look at the economy, and the way we would look at it would be in terms of about 8 major dimensions. The first and the most important one is that you would have seen in the economic survey that the growth is estimated at about 9.2% for FY22. Now, in the coming year, the growth has been pegged at about 8.8 to 8.5% by the government, which I think by view of many experts and leaders is fairly conservative in its approach. Given the fact that I think even the World Bank is actually talking about a slightly higher rate for India, and I think everybody expects it to be in the same 9.2% bracket. So to that extent, I think the first thing to note is that I think the foundational element of the growth rate of the economy, and therefore the traction that we are seeing, will significantly be there in the same trend as what we have seen in FY22. So that's point one to note. Although you would read in the budget that the estimate that the FM presented was only about 8 to 8.5%. The second thing which you should note is that in the context of that, and possibly the number is not in the slide, is that the Forex reserves for India are about 639 billion or so at any given point of time, anywhere between 640 to 650 or so. So to that extent, that covers for about 13 plus months of exports. So what it would also mean is that there is a fair degree of internal security as far as the fiscal model is concerned. So the reserves are substantial, and that is also a good area for us to start feeling confident about. So the foreign exchange reserves are also to augment the GDP growth that we had. And just for a context, I think 2 years back in the pre-pandemic levels, you would know that the Forex reserves are only in the order of about $550–560 billion or so. So substantial increase from there. The third thing to keep in context is really the fiscal deficit. One of the things that the budget had put forth is that the fiscal deficit was about 6.9, or rather is expected to be 6.9% this year, and it will trend towards, let's say, about 6.4% going to FY23, and there is a target for FY30 to be sub, and or subsequent years to be sub 4.5 or so. But one of the things that you would also notice is that this target is also fairly achievable, because if you look at what they have planned by disinvestments, etc., is only about 65,000 crores, and I think one transaction can technically take care of it. So to that extent, I think the third dimension, fiscal deficit, while I've indicated this as a weaker outlook in the current form of 6.9%, technically would be much lower going forward. So it may not be 6.4 for FY23, it could still be much lower. So what you would notice is that in the first three dimensions that we discussed, be it GDP growth, be it fiscal deficit, or for that matter, Forex, there is a significant opportunity for us for fiscal consolidation. And to that extent, I think one of the aspects that would be very relevant for us would be the fact that there is room for investments, and therefore there is room for public investment, which is what the government has really focused on. And any public investment really accelerates private investment. So from our sectoral perspective as ICEMA, I think the outlook is outstanding for us to start working on. It's more about implementation rather than about fundamentals. So implementation is obviously one that we need to look at, all of us, be it public investment, be it private investment, but fundamentally the base is pretty strong. The fourth one that we are always worried about is inflation. And I think I go back to what Mr. Vanmiknathan said, because there is a lot of focus on the supply side and also on the fiscal reforms. One of the advantages that we have is that the inflation has been pretty much under check. So we have an inflation which is about 5.6% core inflation. CPI, although WPI is still high, which is a little bit of a cause for concern, but frankly speaking, which is obviously a function of global commodity prices, etc. But essentially, if you look at consumer price index, the consumer price index is also within control, which essentially means that as far as people are concerned, which would also mean our customer side community can actually spend on the right items without being affected by inflation. So that's possibly the fourth dimension. It's a little bit of a consumer dimension rather than our industry dimension, but very relevant to us that we would have to look at. And on top of all this, I think since we also have a fair degree of imports together with exports as well as domestic value addition, I think the rupee is pretty stable, which is there for all of us to see. Marginal reduction about 3% here, 2% here, but fundamentally there is the outlook for the rupee, given that there is also a Forex reserve which is substantial, is pretty much stable. So to that extent, you would find that in terms of all the dimensions which are fundamental and core to the economy, and which also supports the aspect of supply side reforms and also the aspect of investment-led growth, is really sort of coming in place as far as the numbers are concerned. One last thing that I thought will also be very relevant to us is the FDI per se. So a discussion has always been that has the FDI come down, but if you really look at the FDI, and I think we looked at something like about 25 billion between April and November. I know some of the large mega deals that we had the previous year are not there, but otherwise this is also pretty much trending. And for the entire year, I think it was about 47 billion or so. So to that extent, I think the FDI, I mean the calendar year. So to that extent, I think the FDI is also pretty positive. So to that extent, I think just a summary, all the fundamental elements that sort of make up the economy, and also those which are aligned to the aspirations of the budget in terms of like what I said, investment-led growth, really sort of falling in place. So to that extent, fairly positive for us. And as ICEMA, I think we'll also talk about some of the infrastructure reforms that have come up and the announcement subsequently in the budget. I think those are also really aligning to these foundational elements. So that's sort of the first cut of where the economy is and how does it fit into the dimensions of the budget. Now, specifically getting to the budget, and I think there are two areas which would be of interest to you. And I would leave it to Jimit and to Anup to sort of talk about the specifics. The first one is really around infrastructure, and very clearly, just like a continuation of the prior year, there's a lot of focus on infrastructure-led growth. So we are talking about 25,000 kilometers of national highways. We are actually talking about a significant expansion along rail, airports, ports, as well as mass transport systems. So to that extent, I think a big continuation of the national infrastructure investment plan that we spoke about. The second is, I think there is also a big transformative approach-driven model under Gati Shakti. And to that extent, it will have two impacts on it. The first one is really the aspiration of world-class infrastructure, and therefore that meaning that we will also have the opportunity to drive world-class products for creating those world-class infrastructure from our side. So to that extent, I think that's the second. I think from our ICEMA perspective, I would say that that's a very important dimension for us to look for. The third one is really around the approach being powered by clean energy, and therefore there is a fair degree of coordination that is going to happen between state, central, and the private sector. So one of the things that as ICEMA we may need to also watch out for is what are reforms which are happening on the clean energy side, especially on the engine side and the transmission side, which will have an implication on our business. So we should watch out for some dimensions to happen into the future, potentially as either standards or as reforms coming in. And primarily, there will also be a fair degree of data that's getting generated. So while this is long term for us, I think we would also be able to leverage a lot of the data that would be exchanged under the Unified Logistics Interface platform. And therefore, a lot of it would also be relevant to us to really understand aspects around traffic management and therefore the implications on ICEMA. So there's a big continuation as far as infrastructure is concerned from an ICEMA perspective, more specifically the roads and the rail part, which is becoming very relevant. And finally, from an MSME perspective, and this is primarily because you will have a lot of your value chain being driven by MSMEs. I think the MSME perspective is on two areas. The first one of relevance is the ramping and accelerating of the MSME performance, for what we call as a RAMP program. There is an outlay of about, let's say, $1 billion or so, roughly, which is there on the annual that will be rolled out for the MSME sector. So therefore, a lot of our MSME participants can leverage that. And this again, going back, it's not just giving money in the hands of MSMEs, but really helping them to enhance their competitiveness. So fairly good. I think about $900 million of 60 billion rupees is there. That's a fairly big aspect that would be relevant to. And the other aspect is also affordable housing. I think while it's an adjacent sector to us, I think a number of the dimensions for all the housing and related construction programs that have been provided in the budget provides a significant opportunity for us. So if you really look at the macroeconomic fundamentals that we spoke about and the 2 or 3 drivers, be it infrastructure, be it land, for that matter, the other aspects of infrastructure that they are looking at, that's essentially going to be the real thrust for growth from our perspective. So that's in summary a quick view of the budget and some of the aspects that could be relevant to you. Maybe we can take some questions later, but Dr. Bakshi, back to you, or Jimit, over to you for the next ones.
Thank
Yeah.
you. Coming to the direct tax proposals, in next 16 odd minutes, we'll try to touch upon some of the important aspects of direct tax. If you see, almost 80 odd amendments have been made in direct tax, but mainly procedural in nature. So we'll touch upon some of the important aspects, and if there is anything specific you would like to ask, I would be happy to answer separately. Coming to the corporate rate tax, of course, there has been no change as such, except 2 changes as such. If you ask me, one is that for manufacturing companies, those who wanted to set up before 31st March 2023, that date has been extended to 31st March 2024. On the rationale that because of COVID, the construction could not happen, so they have extended the date. And the second change is mainly for companies which are entering into consortium arrangements. So today, when in infrastructure sector, typically various companies come together and bid for a project. And in case you form an AOP, the tax rate or the surcharge in that case, one of the interpretation was that the surcharge is 37%, which was very, very high. So they've reduced that rate to 15%. So indirectly, if you see the last line here is that the rate has reduced from 42% to 35% for those AOPs or the Indian parties who are actually going to pay their 42% rate. So that's one significant change which has been brought in from a tax rate. Otherwise, there has been no other change as such. Of course, there have been no clarifications issued for SCP, significant economic presence or anything, maybe because there is something which is already coming up. If you move to the next slide, if you see all the changes which have been made has been mainly around reversal of all the judicial precedents which were actually in favor of the SSEs, that has been reversed. So one of the decision was on education cess, where practically good amount of companies used to claim this as a deduction based on several High Court decisions of Rajasthan and Mumbai High Court, where it stated that you can claim education cess as a deduction. And that has been now overturned with retrospective effect, which is against the policy of the government, because this government had promised that they will not make retrospective amendments. But I think so they've gone back on their word and made a retrospective amendment as far as health and education cess deduction is concerned. They've also made an amendment on 14A. Typically, when you have subsidiary, you receive dividends. Actually, this is of much relevance for the previous years where dividend was exempt and good amount of incomes were exempt. Now, since it has become taxable, from going forward anyway, 14A will have less of relevance. But still, they have made certain amendments that if you have incurred certain expenditure to earn the exempt income, it will not. So at that time, 14A based on judicial precedents, companies should take that 14A disallowance cannot be happen, and they used to claim this expenditure against the non-exempt income, which now the government is saying, sorry, it's against the intention. While the government is saying that this is from prospective effect, the manner in which they have drafted these provisions, it says it's that they've clarified it. And when they say they have clarified it, at a lower level, the tax officer will really say that this is actually always the intention, and there will be litigation on this front, which you can expect, especially for the past years when dividend was exempt. So I won't be surprised if there is litigation on that front. Another, couple of amendments which they had actually made were mainly for any expenditure, and this is again a reversal of decisions for if you're making any expenditure or paying any fine, which is a compounding on offense, even under the foreign law or anything, it will not be allowed as a deduction going forward. Because there were certain judicial precedents in some context, they've reversed this. The next aspect is today, if you are an Indian company having subsidiary abroad, if you would have received a dividend from the foreign subsidiary before 31st of March 2022, then the tax rate will be 15%. But if you receive after that, the tax rate will increase to your normal tax rate, which will be your either 22, 25 or 34%, depending on which regime you have adopted. So in case you have subsidiaries abroad and there is surplus cash, anyway we're planning to declare dividend, you may want to get the dividend before 31st of March to avail the lower tax, else it will be taxed at a normal rate. Then there were certain amendments, again, as I said, to override the decisions on cash credits. Cash credits means basically what happened whenever there is to be share capital infusion, you always have to prove the source of the funds from whom did you get the share infusion, and whether there's a genuine source and everything, how did you get the funds? That was there only for share capital. Now they've expanded that ambit to loans and borrowings as well. While there is some drafting error in this bill, apparently they have redrafted the section but deleted share application by mistake. I think so that will be restored very soon. But net, now even if you are borrowing from somebody, earlier you used to give the name of the borrower and that was enough. Now you'll have to also prove the credit worthiness of the borrower to get, otherwise you will be taxed under 68. And I would say in assessments, this has been a very favorite topic by the tax officer. So you may want to actually take care and gather all the documents at the time of borrowing itself rather than waiting for the assessments to be. If I go to the next slide, lot of things were said on cryptocurrency, and still it is technically, if you ask me, it's still officially illegitimate. There is no guarantee that that will be legitimate or not. But there are various people who have invested this money in this crypto, technically at this point of time illegally, but they want certain incomes. Maybe they wanted to offer, because illegal income is also taxed. They wanted to offer this income, maybe at 10%, 20%, treating this as shares, or not offering this income at all because saying that crypto, there is no specific mention under the Income Tax Act. So the government said, might as well, rather than going into litigation, at least let me tax crypto, at least whoever has done, even if it illegally, till RBI or any other authority comes out with the crypto bill and whether it's legitimate or not. But at least they want to tax at a very high rate on 30%. Now, there are discussions going on whether this is 30% and what is the rate of surcharge, because it's a capital asset or not. And there's a possible view that the surcharge could be as high as 37%, in which rate practically your crypto income could be taxed at 43% as well. That's one of the view which is existing. Maybe hopefully some clarifications will come. And plus any losses on this will not be allowed as a thing. So if you see, the government's intention is to discourage the cryptocurrency, but that's, we have to see, wait and watch once the crypto bill comes out. If you go to the next slide, as I said, we have discussed this on the manufacturing. There is an extended. On the startups also, there was already an exemption or the tax holiday provided. They've extended that by 1 more year, mainly because they believe due to COVID, there were not many companies who would have availed this, so they have extended that as well. Otherwise, no significant amendments for them. Next, if you see from a business reorganization perspective today, and this again, I said this is, one is a reversal of decisions and one is practical instances where a lot of representations made it. I'll just give 2 examples. One example, say that entity, there's an existing entity, you want to demerge that entity into 2. But by the time the NCLT order comes and everything, sometimes because due to COVID, there were orders which were coming after 2 to 3 years. Now, by the time you demerge those entities, the existing entity would have continued to file the return of income. And at the time of demerger, you have an option of making a retrospective thing. You would have filed for a retrospective demerger, in which case you will have to refile your income tax returns for both the entities again. And there was no provision under the law which allowed you to do so. You would have to approach the CBDT to do that. So now these provisions allow you to do so within 6 months. And second is the reversal of the judicial precedents, where say one entity is there, 2 entities are there, both are getting merged. And on the entity which is getting merged, say there is a reassessment or some notice which is issued for the past year. The ground which SSC is issued to take is that this entity no longer is in existence. So this notice is void. So no assessment can be made. So now they have clarified, in this case, assessment can be made on the successor entity so that the government does not lose its tax revenue. So again, that's, if you see, is a clarificatory or a reversal of the decision which has been passed by the higher courts. Last year, as you are aware, there were amendments on goodwill, prompt retrospective effect. Again, for that year, that depreciation on goodwill will not be allowed. And if there are any goodwill which is there, WDV of those needs to be reduced from the block of assets. Now, obviously, once you reduce it from the block of assets, there is a concept, if you reduce, it will be amounting to transfer. And if there is any transfer, then there will be capital gains. So while the computation mechanism did contain that, okay, the amount, if it is there, how do you compute capital gains? But the charging provision was missing. And that is why, if you see, this is more like a clarificatory amendment made so that if there is any capital gains, department can tax those capital gains in an account of reduction of block due to removal of goodwill from that block. So again, this is more like a clarificatory amendment. If you move to the next slide, again, if you see, the government has been emphasizing a lot on litigation management. The government wants to ensure that less and less cases are filed because they know judiciary is overburdened. Even the department is overburdened. What they've done is very simple. The government used to fight on a particular legal issue again and again. And let's take a simple example of 14A. I'm just giving a hypothetical example to explain. Say there is so many SSEs, 10,000, 20,000 SSEs have claimed the same issue of 14A. Department is filing 20,000 appeals on same question of law before High Court and Supreme Court. So 20,000 hearings, 20,000 cases, 20,000 orders. And the issue is same. So the department has to waste so much of time in filing the appeal, and so much time of judiciary is wasted. So they said that, okay, if there is one case pending for any of the SSE on that particular legal matter, let that matter get resolved. And if that matter is in favor of the SSE, department will not file this case of 80,000 SSEs, and hopefully litigation will get reduced. If it comes in favor, there will be provisions made to show that actually department will get additional time, that once the order is received, within 6 months you can file an appeal. So department will then file an appeal and try to get that in your favor. Of course, from your point of view, from company's point of view, you of course will have an option whether you want department to exercise this option, and whether you want your fate to be decided in somebody's hand, or whether you will like to litigate it yourself. And remember, this will be applicable when tribunal decisions are in your favor, that is SSE's favor, then this provision gets triggered. The second provision which again gets triggered is sometimes when your department is now collating a lot of information from everywhere, and we are all humans ultimately. Possibly as a company, when you're filing returns, there are some genuine errors made. And maybe you have realized it later on that there is some genuine error made and income was maybe genuinely because of some genuine error not offered to tax. You want to offer to tax, but now the revision of return is by end of the year. Practically, you get only 3 months or 4 months to revise your return. And if you realize it after that, there is no way you could have revised your return and offered it to tax. The only way you could have done is to write a letter to the assessment officer, in which case you run a penalty exposure. And that is why the government is saying, okay, fair enough. We are also collating information. We will, if we find out that you have not offered it correctly, we'll indirectly provide you an opportunity of being heard. We'll provide you that thing that in our view, you've not offered it correctly. And this is the basis why we are saying so. Please update your return, offer this income. But because you have done a mistake, instead of paying your normal tax, pay me tax of 1.25 times if it is within 1 year of the end of the year, or 1.5 times of the tax if it is within 2 years. So indirectly, it's like a VSV, which Vivarsha Vishwa scheme, which the government is now imbibing under the act. But practically, its applicability will be for genuine mistakes which have happened by the SSCs and which they realize it later on, either themselves or by the department will send out a notice to them. Coming to the next point, and which is it's almost to the end of points which we are saying, government's emphasis on this has been only one. Government has been very focused on tracking your payments. So that is why every year, if this government, you see last 6-7 years, they have always imposed lot of tracking mechanisms by way of imposing TDS even on purchase of goods as low as 0.1%. The idea is not revenue collection. The idea is only to track. If you're purchasing goods from someone, if you're making 0.1% deduction, it will come in your TDS certificate. The other person will have to report it. Similarly, this year also they have introduced TDS provision, which is on something called as valuation of perpetuate. So you will be giving various schemes, benefit schemes or marketing schemes to your dealers, distributors, retailers, possibly, and say you're giving something, say an iPhone to them on as a gift for achieving certain target. Okay, it's a benefit to them. iPhone is worth 50,000-60,000. Are they paying tax on it because they have received gift? No, they may not even be declaring it now because but the company who is paying this will be claiming this as a marketing expense. So they want all these expenses to be tracked. And now companies will have to going forward deduct tax at 10% on this, so that the other party then consider this as a benefit and pay 30% tax on it. So this is another important amendment which you would like to take care. And the second important amendment which I would like to bring to everybody's notice, which you will have to do it, is today when you're making payments to overseas parties, you take services of various non-residents, and the non-residents generally put a condition to you that, oh, if there are any Indian taxes, Indian company, you bear the taxes. I am not going to bear the taxes. You gross up the tax. And sometimes the Indian companies, because they take the help of their consultants, they find that, oh, there are debatable views. What should I do? Take conservative views, because if you don't take conservative view, you are suffering a risk of penalty, disallowance, interest, everything. Then they may disallow the payment and make the full payment and bear the taxes. Sometimes the amount involved is very significant. If you believe that amount is not taxable, you can actually approach the department and take back a refund. And that's a provision which they have introduced. There was an earlier circular to this effect, but the procedure was different. Now they have made it a little bit simpler. You can take your money back from the department if you have grossed up, and if you believe that it should not be taxable at all. So that's the another provision which are there. There are another provisions on assessment and reassessment, but because of paucity of time, we may want to skip it. Only one line on those. On reassessment, unlike last year, which this government said that they have actually reduced the scope of reassessment. Now they have taken a backdoor entry by increasing the scope of 10 years and widening the scope. Indirectly, I would say now the reassessment scope has widened. 3 years is very small, and for 10 years, the scope is very wide. So it's not really a rationalization in my view on reassessment. And on faceless, government has done certain measures just to ensure that they don't lose out on rates, at least for maximum years. That's it. So maybe that was a very quick overview on direct tax, but would be happy to answer any questions or going into details maybe separately. Maybe I will hand over to Anup for the indirect tax.
Thanks, Jamil.
Anup?
Yeah, no. Anup, we can't hear you.
Anup? You're not able to hear you, Anup.
Can you hear me now?
Yeah, now we can hear
Yes.
you.
Thank you. Thank you, Anup.
Okay. Yeah, so I'll start with the, I'll start with the customs changes. So from a customs perspective, as in direct tax, the change is primarily from a legal aspect. There has been a decision in Canon India, wherein it is said that the investigation done by DGCI, DRI, and other authorities, where the show cause notice has been issued by a person other than the authorized, other than the prescribed person, it will be invalid in law. Now they have gone back into the law and amended with retrospective effect that the show cause notices issued by DRI is valid, and this will have a serious effect in the sense that in those cases which has been closed or rather has been concluded on the basis of Canon India will now be some of it will be reopened, and there has been multiple applications made even in CSTAT and other places for early hearing that will also be adversely impacted. Second change is in the import of goods under concessional duty regime. Earlier, the permission had to be sought qua parcel. Now they've automated it and made the process of permissions annual. So to that extent, it is a friendly amendment which has happened. The third major change is in advance ruling. What has happened is that earlier the advance ruling, once you take it, it was unless there is a law change, law change or a fact change. But now what has happened is that they come out with a prescribed period that after 3 years you have to revisit and take a fresh. I mean, the validity of advance ruling is only for 3 years, which is, in my opinion, slightly is not at all SSC friendly, because in order to get the advance ruling, you'll have to wait for almost 1.5 years, and if the validity is only 3 years, then you really cannot make a long-term decision on that basis. I'm sure that there will be a lot of representation going in this particular aspect, and the government will consider it favorably, because that in any way doesn't kind of encourage the investor sentiment in that sense. So these are the key amendments. There is also one more amendment which says that the publication of import-export data in an unauthorized manner is a punishable offense. So earlier people used to collect it from whatever channels, and they used to share it for a consideration. Now the government has made it a punishable offense. Therefore, accessing this information would be that much more difficult. Yeah, can you go into the next slide, please? Tariff changes, in a way, what has happened is that over a period of time, a lot of notifications has become redundant, and there has been notifications and amendment. It was becoming increasingly difficult for somebody to find out what is the correct rate applicable for import, which used to result in a lot of confusion. So what they have done is that they have streamlined it and removed a lot of notifications which are not relevant anymore. A lot more exemption notification, which are unconditional exemptions, basically has been captured into tariff. So to that extent, it's an SSC friendly exercise which has happened. There has been a revamping of project import. Earlier, there has been a concessional duty applicable for project imports, and the notification has been very widely worded. So what happened is that the goods, many a times the Indian manufacturers were finding it increasingly difficult to compete in the space, and therefore what the government has done in the current notification is that they are phasing out um, uh, in a phased manner, and also for the goods which are not easily available in India, they are coming out with separate exemption notification. So that is a kind of strengthen the manufacturing in India, and it is in line with the government's policy of making in India. Yeah. I would just skip into the next one now, because these are essentially some of the rate changes and other things. We'll skip the rate changes. Probably if there is any specific query regarding the rate, we can try and take it later. Again, it's more to do with the rate changes. Get into the next slide. Yeah, so earlier, where the customs duty was unconditionally exempted, the department was demanding social welfare cess on the national customs duty. Now, there has also been a decision in Unicorn wherein it has been held that the customs duty is payable, the SWS is payable even if customs duty is exempted. Now, they come out with a sort of clarification saying that in case customs duty is exempted, then SWS is not payable. The only challenge, as I could see, is that that there is decisions of courts which says that SWS is in that sense payable. So typically, where there is a judgment, it should ideally be undone by a appropriate amendment in the Act itself, or by Act itself, instead of it coming out with a circular, because there are certain decisions of the Supreme Court which says that if there is a conflict between the circular and the judgment will prevail. As of now, given the government's approach, field formation may be happy to implement it, but at a later point of time, I don't know. If some assessing officer choose to disregard the circular, there is little an assessee can do. So that's an area, and probably can you go back? There was a couple of more other points. Yeah. So revocation of steel and the duty on kind of steel bars from China. Now there has been an anti-dumping duty, so which is making it very expensive for us to import. Steel being an essential raw material for many of the industries, making in India is becoming, I mean, any goods which is made in India to that extent was becoming more expensive. They've gone back and at least rescinded the notification for the time being. There has also been certain changes which is aimed at aligning our customs tariff with the global WCO customs tariff. So that is the key changes. Yeah, can you go into the next slide? Already covered rescission of obsolete notification here. So that is briefly about customs. So in customs, another key change, a rate change, which must be of interest to you, could be that there has been a PLI. For multiple areas, there has been a PLI which has been declared. And the government is looking at increasing the customs rate where the manufacturing in India is gathering momentum or is becoming more self-sufficient. So the way I look at it is that there's a lot of focus on it, on more and more industries that where local capability building is what the government is expecting. So if you find any of your case, because of certain import policy, concession duty of customs or anything, if your industry is having any serious concern, I think it will be a good time for you to reach out, because the government is very sympathetic to the demand, to the reasonable demands of the local industry. It's not that we'll go back into 60-70% of the duty regime which used to happen say about 15-16 years back, but a reasonable tariff protection is what you can look at it. 10-15% is also a good deterrent. Yeah, so with that, I will go to goods and service tax. Goods and service tax, what has happened was that first the major change is that there is a law amendment saying that going forward, instead of 2A, there will be a new statement called GST or 2B, which is going to be issued. 2B will give you the matched items. That is where you have purchased some goods and the vendor has uploaded the invoices and complied with the tax requirements. Only those matched invoices will come, and you can take credit only in respect of the matched invoices. And even in 2B, they will further segregate into what is eligible credit and what is ineligible credit. Now, ineligible credit is those which the government thinks that some vendor has got a suspicious background. So somebody who has not been regularly paying paying GST, or has been under declaring or over utilizing the credit and all. There is 4 to 5 aspects which they have prescribed. So if they find that any of those criteria, vendor in that sense is not a very reliable one as far as the GST authorities are concerned, there has been a talk of earlier blacklisting him. It is more or less in that sense that the new regulation says that they will kind of notify him as a person. They will block the credit. So while you end up paying the GST to the vendor, you will not be able to avail the credit. At times, this sort of a change could be draconian in nature, because if while the details are still awaited, if the discretion is left to the revenue authorities to kind of make somebody's credit ineligible to the customers, we have to be very doubly sure of how to what extent, how carefully, carefully they exercise such authority. Because if your credit is not available to the vendors, then the first thing is that the market standing will erode, and a lot of people who are currently dealing with you in that sense would going forward will be very reluctant to deal with you. Therefore, GST compliance, payment of taxes, and appropriate accounting becomes very much more important. It's not just a simple compliance issue or a penalty issue. It could at times, if there is multiple non-compliance, it could result into a business continuity issue itself. The others are, GST availment. Now the time period is extended up to 30th November. So, you get approximately 1 more month to avail the GST credit. Time limit for credit note is extended, and payment of tax by the vendor. So that is said that where interest. Were interested. It was there earlier also that it has not been paid. You let reverse it and re-avail it after the supplier paying the tax. Yeah, go into the next slide. Cancellation of GST registration. In this context, what happens is that in certain criteria, they are telling that the departmental authorities will have a right to cancel the GST registration suo motu. So for composition dealers, if they are not filing the return for 3 months from the due date, the registration will be cancelled. For others, they will prescribe the period. Earlier it was prescribed as 6 months. Maybe they will come out with a new timeline now. There has been an issue in terms of sometimes, there is an imbalance in the cash register of GST. Like you may end up having a huge cash balance in one branch or one registration, and others you may have to pay it in cash in order to address the GST payment requirement. So what the law has been amended to provide that you can easily transfer CGST and IGST from one distinct person to another, in the sense that you have got a registration in Bombay and another in, say, Delhi. You can transfer the Bombay cash balance to Delhi, not the credit balance. So that is to be taken note of. And second aspect is that there is also, if you have got a huge cash balance, you can also ask for a refund. So these are the two options which has been given. There has been some time last year the government has introduced TCS return in respect of GST. It is more relevant for e-commerce operators, and now they come out with a late fee for delayed filing of TCS returns. There are some procedural refunds, procedure clarification, in the sense that earlier for supply to AC said. One was not, I mean, there has been a lack of clarity on what is the time by which the refund claim has to be made. So now it has been clarified that the relevant date of it will be from whatever is there, it will be 2 years from the relevant date of filing of the ITC returns. So so that is the key changes. Can you go into the next slide, please? No, don't get into that. So Central Excise Act, the key changes, I mean, primarily in respect to the fuel, and it is more relevant for petroleum companies. I'm not sure whether anybody is there on that, but essentially it says that if there is any blended fuel and you are not blending it with ethanol, then there will be a increased duty of 2 rupees. What it could mean is that it could increase the demand for ethanol by petroleum companies. So there might be capacity expansion in most of the sugar mills and refining of alcohol into ethanol. So that could be, if anybody is engaged in that business, there could be a potential boom over there. Yeah, that's from my side.
Yeah. Thank you, Ishwar, Jimit, and Anu for this very, very detailed and very relevant presentation. I'm sure for the stakeholders who deal in direct taxes, indirect taxes, as well as finance, it was really useful. In case participants have any questions, you kindly post the same in the chat box. We will take the same in the end of the session. Yeah. We now move to the yet another section, which is the panel discussion, which will be moderated by Ms. Bella Shetterao, partner indirect tax Deloitte. Welcome, Bella, and over to you. Yeah, Bella.
Yeah, thank you, Mr. Bakshi, and a warm welcome, to all the panelists. Let me introduce my panelists for today. Mr. Anand Sundaresan, one of the past presidents of ICEMA and the managing director of Aman India Private Limited, a group company of the world's leading Aman Group. Mr. Deepak Garg, the convener of the Strategic Partnership Panel of ICEMA and managing director of Sani Heavy Industry India Private Limited. Mr. Gokul Chaudhary, he is a partner with Deloitte, the global leader People and Purpose, and also leads the global service line for business tax. And of course, Mr. Bakshi will also be a part of the panel and will take some of the questions. So, a warm welcome to all my panelists. And I think we've set the stage, in terms of where the industry is, what the tax issues have got resolved, not resolved in the budget till now. So let's have some discussions around that. To begin with, my first question, which is an open question to all the panelists, is what are your one or two key takeaways from the budget, and what impact will these have on the economy and specifically on your industry? So yeah, can I start with you, Mr. Anand Sundaresan? We're not able to hear. Mr. Sundaresan?
Anandji, you're on mute, please.
Okay, am I audible now?
Yes.
Thanks.
Okay, sorry. Yeah, so nice to be here again on this panel. The budget has been really quite good for us. We have been passing through real tough time in the last couple of years due to pandemic, extensive rains, extended rains, and blah blah blah, all those things. But at least this time we are hopeful that we can put all this behind us. The investment that has been projected in the coming years for the infrastructure development, that definitely will boost the business for construction equipment. So whether it is for the normal moving other machines or also for the other machines, because a lot of things are there. The Gati Shakti master plan, that's going to be really very, very good. It will, the road construction, infrastructure construction. So all around, all equipments, there will be huge business opportunity, be it earth moving or road machinery or concreting equipment, material handling equipment. I think everyone, if these, even 50% of what they have projected is implemented, I think we will be better off we'll be much better than what we were in the year 2020 and 2021. That's from my side. So we are quite happy about it.
Happy and hopeful and into a brighter future. Mr. Deepak Garg?
Agree with Anand that Gati Shakti is going to give not only Gati but Shakti as well as direction, I would say. So Disha also, probably to the infrastructure of India. So I think very important would be the alignment and integration, with which the Gati Shakti has been launched. The second thing is we talked about, I think the budget talks about 25,000. This I'm talking of the short term, which means immediate next year. 25,000 kilometers of NHI, which means 83 kilometers per day practically. So I think that is something which we need to look forward to, because this is something which may even become challenging for the equipment suppliers. So I think if we are able to reach that 80 plus kilometers per day, I think this will be a really, really new peak for India in terms of infrastructure. The third thing is the interlinking of rivers. So finally, after 7 or 8 years since we, restarted this thought of Ken Betwa link, we also hear of 5 more DPRs which have been completed, and there is an assurance that the tenders for these would be completed in 2022-23, which means we will see the work starting next or the FY24. So that I think is a very good thing, which will open up the demand for the infrastructure sector in a big way. 7.5 lakh of capex commitment, which of course has some of the, you can say, the bad assets to be provisioned for or whatever, like Air India this time. But I think still it has a good room for infrastructure going forward. So I think we have a very, very sound story. We have a very, I would say, infrastructure segment, and we CE companies would be very lucky if the execution is equally committed.
Thank you, Mr. Garg. So extremely bullish about the budget, the Gati, the Shakti, and the Disha. Mr. Bakshi, yeah. So with the the OEMs very bullish. What do you say from the finance perspective?
So we, the financiers also echo the same sentiment in terms of the announcements made in the budget in terms of focus on infrastructure, and that we are seeing. I'll take you from what Ishwar said. It is, the word is continuity. I think it is more about continuity rather than making statements on the projects this year. I think government has continued the projects what they or the schemes what they launched last year. And and the only thing which I feel is there would be a change in a little bit in the kind of equipment, probably because the focus would be on railways, waterways, and green energy. So these are the 3 focus areas. However, the focus on road, as Deepak said, would continue. However, the incremental allocation of the budget on road and highways is little less compared to railways. The incremental allocation on railways is about 14%, while on highways and roads it is less than 1%. But having said that, from the financer's perspective, the ECLGS scheme, which has been extended till March 23, and 50,000 crore further have been added to it. So that will help, because a lot of customers have not still not come out of the problem, because particularly the lower strata of the clients have been facing cash flow issues, and those who suffered from all the 3 waves, either directly or indirectly, are still to recover. And I think this scheme would go a long way in helping them. And there is also what Ishwar also talked about was a revamp of the CGTMSE scheme. I think this is one thing which because all members are there, I'll request that this scheme is used by the other industries very well. By the banks and NBFCs. I think construction equipment industry should also use this scheme very well, and it's a very, very powerful scheme. And once it is revamped, and they are saying about 2 lakh crores would be expended in this, I think that will help the industry. And as I'll echo what Deepak said. I think the implementation and fund flow is very, very important to these announcements. And this time, they've not talked about the monetization pipeline. They've talked about 20,000 crore monetization of by through NHAI, basically through the TOT projects, but they've not they've been a little silent about the monetization program. However, we assume that whatever was said in the last budget would be implemented this year. So yeah, this is from me, Bella. Thank you.
Excellent. Thank you. So Gokul, you've heard from the industry, very bullish, on the budget. The only if they have is, on the implementation. But as an outside and expert on this sector, what are your views?
So, Bella, when the finance minister finally commended the budget to the House at 12:30, I think everyone in corporate India had a sigh of relief. For two reasons. One is, of course, it was a very bold budget insofar as the capex build is concerned, infrastructure build is concerned, which is all what we need as an economy. So that was the great news. I think the nervousness was that where is this going to get financed from, and are we going to see some bad taxes coming in or some nasty taxes coming through? So I think the relief was that there wasn't any deviation from the tax policies that the government had embarked upon. To arrive at that tax policy, I'll have to take you back to when Mr. Jaitley presented, I think, the 2015 budget, when he said that the policy of this government will be to have a moderate rates of taxes with low exemptions. And we started the journey nearly 5 years ago, and it's taken us 5 years to get to a point where we have relatively competitive corporate tax rates, which is of course 15% for new manufacturing, but 25% generally, as what Jimit showed us. So I think we arrived at it, and that has started yielding results for us as an outcome. Firstly, if you look at the finance document closely, you'll see that simply if you look at corporate taxes, the rates have come down, but the corporate tax collection went up by 38% this year. In spite of the pandemic, in spite of the lower rates, there's 38% growth in corporate taxes that took place. The second thing which is very important is all heads of taxes that the government has, whether it's GST, whether it's corporate tax, whether it's personal tax, all of them in the revised estimate were higher than the budgeted estimate, which means that somewhere the system is working now, that we are able to collect taxes far greater than before with far more moderate rates of taxes and far more voluntary compliance. So I think the stability of the regime is extremely important. So what does it mean for our industry? I think what it means for our industry here is that we are entered a phase where there is going to be strong market growth for our products, but we also are entering a phase from a fiscal and economic regime perspective where there's some degree of stability, continuity, and predictability. That's good news.
Yeah, excellent news. Gokul, you also work on the oil and gas sector, and we did also check with you. The one assumption in the budget is on the oil price, the stability of the oil price. But we know where it is today. It's already much higher. So do you think that could really derail any of these numbers that you spoke about, and what was made in the parliament?
Well, the oil price is now close to $90 and a barrel, whereas the whole budget exercise is based on about $75 a barrel. I think the important thing what the finance minister said, and even more important, I see, is the Prime Minister's speech to the business community, which he did as a mainstream of the Davos meeting, which happened about 2 weeks ago. And what did he say? And he said, look, we have to significantly invest in building a renewable sector. And it's not that it's just a pipe dream, because today, if you look at it, 40% of our entire power generation capacity is from renewables. So we've already reached 40% electricity generation from the renewable sector. He has also said that we want to move towards EVs in a big way, which is where they're bringing in the salvage policy. They're also trying to now bring in the PLI for the solar industry. So there's a significant build on one side, which is on renewables. But I think somewhere which we're going to see greater thrust coming in is going to be the building of the circular economy. An economy where we are going to not have waste and throw, but we're going to actually try and salvage and recover and replenish our natural resources, including everything that we are going to be doing insofar as the automotive sector is concerned and other electronic sector is concerned. So I think the building of the circular economy is going to be a big theme that will build up.
Thanks for that, Gokul. Moving on, what Ishwar mentioned too, that the fiscal deficit this year is at 6.9, projected to be lower next year, and likely to achieve the fiscal deficit target of 4.5 in 2026. Again, with the expected, all of you all mentioned the support to infrastructure, the kind of focus in infrastructure that the government is giving. So how is the industry, geared to partner? Because clearly the government has talked about public-private partnership, right? It is just putting its first step forward, right? It does expect the industry to support it on this journey. So, Mr. Anand Sundaresan, how do you think the industry is now geared to support?
Well, from the industry capacity point of view, I don't think that there is a problem, because if you see, when we had the recession in 2009, around that time we had the number of units sold were roughly about 45,000 units of different types of construction equipment. But then, India was the only country which bounced back immediately. We had Pranab Mukherjee was the finance minister at that time, and he gave some sops, and then 2010 was quite good. 2011 was even better than that. So that was the time our numbers, the total number of units produced were about 75,000 units odd. And that was the time the manufacturers, we thought that, there is no going back for India or the Indian manufacturers, because our economy is going to be really very strong. So we all invested a hell of a lot of money in increasing capacity and all those things. But unfortunately, it so happened that in 2012, again, we were down by almost 30%, the market went down. And in 2015, the number of units sold was only about 50,000 units. So at that time, we used to talk about, we said that, what is the installed capacity and what is it that the people are doing? So this was ranging between 30% in certain cases up to 50% or 60% in some cases, depending upon the type of products that they are manufacturing a lot. And then again, it started going up in 2016, 17, and 18, 19 was the best period for us, where the industry reached about 100,000, roughly 100,000 units. So still there was a capacity available, which means another 20, 30,000 units within the installed capacity. It was possible to manufacture that. But in the meantime, also a lot of people have invested, expanded their capacity, because we have started also exporting. Most of us have started exporting the construction equipment from India. So of course, probably we are not ready for this 25,000 kilometers or 83 kilometers a day, what Deepak calculated, which is true. But for sure, we have reached up to 39 kilometers a day a couple of years ago, and we were servicing the market. And so going from 39 kilometers to, as I mentioned, 50%, even 50% of this, then definitely we have that definite capacity. But the only challenge, what I feel is that now it is, even though the numbers are good, it is a very nice pain, but doing business is going to be more and more challenging for us, because the expectation of the customers are going up. At the same time, the input cost has gone up. We don't have any support from the government with respect to such a huge increase in steel cost. In the last 1 year, it is practically 80%. Along with that, the commodity prices have gone up, so our input costs have gone up. Added to that, we have also, our industry, we become, what shall I say, happy very fast, or we try to do very fast, and we start. All of us are probably greedy. We try to undercut each other, and we want to increase the business. So the prices are also going to be under pressure. So which will put in a lot of input cost increase. Already I'm seeing that a lot of poaching, a lot of people shifting from one company to others have started, and this will become even more in the future. This is one challenge which we have to really face. So it's not only the input cost, but also the cost of doing business is going to be really very, very high. And this is where we have to look at. Added to that also is that, one of the major financing company, he has gone out of the market. I don't know, most of you know about it. This particular company was financing to the tune of about 30-35% of the construction equipment business. Unfortunately, he is out of circulation now. We have only companies like Tata Capital, SDFC, ICEMA, and these people are financing. And whether we like it or not, more than 70%, 80% of the construction equipment are only bought through NBFC's funding. So this 35% which has gone out is going to make a big impact. Already in many places we are seeing. On top of that, the government also should see it, especially in the state government's area, the payment, the outstandings, the contractors are having to use, they're getting delayed payments, so that's going to put a lot of pressure on that. So there are a lot of challenges, but as far as this industry is concerned, even if the business is going to increase gradually from, let us say, we go back to 40 kilometers a day, let's say, what we were 2 years ago. And from there, we slowly increase to about 80 kilometers a day. I think most of us are ready to invest, ready to expand, and ready to do whatever that is necessary as long as the input material is available. One very important thing at this point of time, what we also have to look at is, we are talking about a lot about Atmanirbhar Bharat and all. So there, we need really many component suppliers. We still are depending a hell of a lot on the imports, on many of our inputs. So these things also have to come in. So if that happens, then the whole ecosystem will evolve and we will be able to meet all the challenges what is in store for us. But then I think it is really a very exciting time if it happens and we don't have another Lehman Brothers or another downturn or another Corona. I think that we are really in for a very excited time going forward. That's from my side. Industry is ready, yes.
Yeah, it's a good place to be. There are challenges, but yeah, maybe some of it, talent runs across the board. So that every industry today has a massive talent run. So I think that's across the board. Coming to you, Mr. Garg, your views, please.
Yeah, I think, Bella, the way it is being projected, I think industry will have to be really geared up. Accordingly, the ICEMA, our industry body, we have made a vision plan 2030. Now, some of the key elements, we need to address this whole scenario in totality. So we have worked on this vision plan 2030 to see, first of all, tech improvement. So technology across products, across platforms, across applications need to be upgraded with the expectations to meet alternative fuel requirements. So you have seen how the blended diesel will be cheaper than the standard diesel going forward from 1st October. So that plus efficiency, telematics, artificial intelligence, and also electrification to some extent. In this vision 2030, the whole industry has started working towards tech improvement from all sides, and this is essentially to improve the efficiency of construction and also to improve the cost structures going forward. Second thing is, as Anand said, we have enough capacities, but I think there is industry is now gearing up for supply chain localization, because as an industry we still have substantial imports which we need to localize, and we have an opportunity to localize. So just now Anup mentioned that government has withdrawn some of the anti-dumping duty on bars and these. Now these were the showstoppers for some of the companies to localize in India. Now if some of the raw material bottlenecks are removed, or they can be managed better, then we can see a large level of localization, and that is what industry is working towards. Now this is basically to again have that stability, continuity, and predictability of supplies with a reasonable cost. So I think this is something which the industry is working very aggressively on, because see, in these today's projects, if the steel cost or cement cost just goes up by 30-40%, where is the viability of the project? So I think this is one very important area which the whole industry is working on. Two more very big areas, I think going forward would be skilling, because as these equipment or number of equipment go up, I think skills required to operate, to maintain, to produce. The whole value chain requires or demands a huge skill, which the industry is working towards. And I'm sure we have an infrastructure equipment skill council under the aegis of ICEMA and with the government. And this is working very aggressively to develop the skills for this sector, for the CE sector. And lastly, and the most important thing, industry is very aggressively working on women empowerment and women employment in CE sector. So, this is one area which industry is working on. I would not say that the percentages are too high today, but I think, as you mentioned, 2026, with a deficit of 4.5%, I hope we will not have any deficit of women in our industry at least. So this is something which the industry is working on to ensure that we meet these challenges of this infrastructure development if we really see this kind of boom coming up.
Thank you so much, Mr. Garg. I think, very, very comprehensive and very detailed answers, both from Mr. Darshan and Mr. Garg on this. But, and it's very heartening to know on women empowerment, sir. So, looking forward to seeing more women in your sector for sure. Moving track now, we've heard the challenges, from the industry, the manufacturing side on, on technology, on finance, on commodities, talent. But the budget is a little bit about the tax policy. It's about regulatory. So let's hear a little bit around that as well. And coming to you, Mr. Bakshi, ICEMA does make pre-budget, recommendations to the government year on year, but it's not much of it is really converted into policy as yet. So what is it? What is it that you would like to really see? Which are the key points that you really like, for the government, so which will further augment, what to support the industry?
Yeah, a couple of points. See, one is, we talked about the GST. This industry particularly, as we said, is aiming to be, say, $25 billion industry by, say, 2030. And at that time, we are envisaging it will be employing about 6 million people, so which is a huge number. And we also contribute to the infrastructure development. We are, in a sense, without these machines, you cannot make the, these large projects, what we are talking about, what the government is talking about. So the construction equipment is basically, you can say the foundation of, the infrastructure vision what the government has. So what we feel is, as an industry, if okay, one more thing is our users. Most of our users are, the individuals, particularly for those smaller machines, like, for example, excavators, backhoe loaders, concrete pumps, these smaller machines, the owners are the individuals, who do not have or do not go for a GST registration, right? While obviously, we need to take the industry towards more towards getting the registration, etc. However, the large part of it is unorganized. So which actually increases the cost of acquisition of equipment for them, and the viability of for them, is comes to a question. And therefore, we would request the government to look into it, to reduce the GST rate from what it is today, say 18% to say 12%. This is a long pending demand from our side. This is from the GST side, and there are, from the user industry perspective, we also represented on see, these infrastructure companies have various SPVs. And when we talk about, these days, particularly when we talk about triple P model, you cannot work in the parent company only, while the EPC contract can be in the parent company, the project has to be taken in an SPV. So at a, some project may be a loss-making project for whatever reason, maybe not because of his fault, but because of ROW issues, because of the land acquisition issues, etc., etc. So the at a consolidated level, they should be allowed to to basically square off the losses against the profits in the other companies. Basically they should be allowed, because this will help the infrastructure sector, because see, the equity is limited, and today in the HAMM model you have to put in about 40% equity. And it's, they cannot bring in unlimited equity, and most of the successful contractors today are owner operators, basically, who are the owners, basically, who have risen to say a 4,000 crore or 6,000 crore company. So a tax regime has to come wherein they can square off the losses. So this is another pending demand, and of course there are various other demands. What I request, because all the members are here, every year we represent the taxation board, direct as well as indirect taxes. We make a representation to the government. So I request the industry to come forward and well, let us make a vision on what is our long term take on the taxation in terms of both direct as well as indirect, and take it up as a you can say as an ongoing project, so that we can keep representing these issues to the government and get what we want. And just to touch upon couple of more demands from from say ICEMA to the government, which probably are not exactly taxation, is the priority sector status lending to the financing industry. We have been demanding that, because we are contributing directly to the infrastructure development, we do require long-term funds, because see, these days equipment lives are increasing. The viability, because of the input cost increasing, the viability of these machines are not 3 or 4 years, which used to be earlier. Today it is 6 years, 7 years. So we as NBFC and banks, should have visibility of long-term financing for these equipment back-to-back basis. And if we have PSL, we will be able to get that kind of funds from banks, or maybe from pension funds, etc., from outside. And from say again, from operational angle, the NBFCs are subject to TDS, which the banks are not. So there also we face some operational challenges, basically, in serving the client and reconciliation, etc. And it's very tedious process. And the way the NBFCs are taxed, see, we are subject to INDS, while the banks are not, and the provisioning requirements for the ECL buckets, etc., is higher in case of NBFCs than banks. So that also brings the NBFC to a little disadvantage in terms of giving credit and taking higher risk what they are meant for. So these are some of the demands which we have, and we keep consolidating and representing to the government. Yeah.
Yes, and I think we should continue doing that. And at some point, I think the industry will see this be applied. But Gokul, over to you. Besides, the challenges Mr. Bakshi explained, what more do you think is required as a tax policy intervention?
So I'll start with a little bit of data here, and then of course I'll converge on to what Mr. Bakshi was saying. When we look at our budget documents that were put out this year, which was the 1st of February, what emerged is that when they did a survey of the 9 lakh companies which are profit making in this country, in 1920, the ETR, the effective tax rate, was 22.54%. So while we may have a corporate tax rate which was then prevailing nearly 30%, but the effective tax rate which was being paid is 22.54, and that was a fundamental basis why they actually moved down the corporate tax rate to 25%, because they realized that it was not viable to be having a high tax rate with high exemptions. It doesn't work. So 22.54% is what the number came down to as actual effective tax rate that the companies are paying. That obviously got me to work and try and see as to where are the main deductions or exemptions and incentives which companies are taking. There are 3 of them: accelerated depreciation, the tax exemptions which are there for infrastructure and power plants, and the third is the export earnings of SEZs. These 3 exemptions consume nearly 76% of the reason why you come down from 30% to 22.54%. So therefore, the first thing is realizing that where is the exemptions currently sitting, and whether the industry believes that these exemptions are being taken to their advantage. That's the first part. The second part which is there is that there are a bunch of incentives which are already there in the Income Tax Act. For example, there was a provision brought in to give incentive for the new workforce hiring. If I look at the data from 2018 till 2020 during the pandemic, interestingly, the exemptions which have been taken for new workforce hiring has gone up from 1,300 crores to 2,100 crores, which means that there's been a 50% greater incentive taking, which effectively means that there is some workforce hiring which is happening. And the question really that was crossing my mind when Mr. Bakshi spoke about the fact that we are going to look at hiring 6 lakhs people or 6 million people. The thing which is in my mind is, does that exemption work for this industry? If yes, there is an exemption in place. If it doesn't work, then what should we be doing to make sure it works for us? That is a simple low-hanging fruit first. Second, I looked at the R&D credit system which exists in our country, because we do have exemptions and incentives for R&D activity. And that is important because, as we heard before, technology is coming in a big way. There's going to be tech adoption as well as innovation around how we're going to get greater efficiency and productivity in our equipment and machines. And the question really in my mind is, why and how much can the industry avail from the R&D benefit which is already there in the Income Tax Act? And if it is not there, then it's far easier for us to lobby to make sure that we get that exemption. I examined that over the last 3 years. I don't think Indian industry has been availing these exemptions very effectively, because when I look at the years from 2018 till 2020, typically about 8,000 crores per year of exemption was being taken. Now, 8,000 crores may be a big number, small number, but the fact is it's a flat number which people have been taking. So it's not been on the rise. So I think if the industry is going through a huge upsurge in a scale of employment and R&D, then we should make those provisions workable for us. The third is this whole big vision for the sector. And I think that's the narrative that has to be carried more effectively into the Ministry of Finance and into the CBDT. The reason is, many years ago, there was a finance secretary who was also the petroleum secretary, who then became principal secretary Prime Minister, Dr. Vijay Kilkar. And when I was working with him at that point of time, he had told me very clearly, he says, when you want these reforms, you need to have a strong story, no doubt, but you need to be able to tell it consistently over a period of time. Because if you're not able to carry that message consistently, these reforms will not happen, or these concessions will not happen for your sector. So I think if we are in a growth-oriented sector, there is a vision for this sector. We have to be able to bring in as to how each of these pieces that we are asking for fit into place, including asking for PLI for our sector. So there's a PLI piece, there's a GST piece, there's an employment piece, there's an R&D piece. There are several pieces in there for us to work upon. So I think as an industry, I think there is this cause for optimism, but there's also some work to be done.
Yeah, thank you, Gokul. And I think so there is a lot of call for action, as we say, for the industry and for ICEMA, a lot of points to think about. We could go on with this discussion, but I think we are on top of our time now. So we will have to end it now. I think it has been very engaging. So thank you all the panelists for for some lovely ideas, your thoughts, your views, and a lot of food for thought. I think, Mr. Bakshi, for ICEMA and plan of action going forward. So with that, I hand it over back to you, Mr. Bakshi.
Thanks, Bella. Thanks for steering the session very, very well and making it very interactive. So there are a couple of questions, in the interest of time, probably, we will revert back to the members on mail. We will note down these questions and we will come back to the members later. So now I request Mr. Karthikeyan to come in for the closing remarks. Mr. Karthikeyan is the co-convener of ICEMA Financial Ecosystem Panel and Group Product Head, Commercial Business, ICICI Bank. Yeah, over to you, Karthik.
Thanks. Actually, I'd like to thank ICEMA and the finance panel for a very engaging session. It was very the discussions that happened were really very fruitful. I think the finance panel will continue to do this activity going forward. I thank each one of you for spending so much of time and giving your thought process. I think India is going to go through a lot of activity in terms of both highway building as well as infrastructure growth, which will propel the industry this year. And I think we'll go back to good times. With this, I'd like to thank each one of you. Thank you so much.
Thank you, Karthik. Thank you. Thank you, everybody.
Thank you.
Thank you.
Thank you. Thank you.
Thank you. Bye-bye.